we need to talk about a financial crisis that's unfolding in Japan right now. And this isn't just a local problem. It's a situation so delicate, so dangerous, it actually threatens to drag the entire global economy down with it. So let's get right into it.
Look, this isn't some far-off theoretical problem. This is happening. Picture this. December 19th, 2025. The Bank of Japan makes a move. They raise interest rates for the first time in forever. Now, this was supposed to be a solution, but instead, they might have just lit the fuse on a global financial time bomb.
And this is where things get really weird. At the center of all this is a paradox. I mean, Economics 101 tells you that when a central bank raises interest rates, it should make the currency stronger, right? But when the Bank of Japan did it, the exact opposite happened. The yen just collapsed. So what on earth is going on? That reaction from the market, make no mistake, it wasn't an accident. It was a message, a really clear and frankly terrifying signal that the market believes Japan is completely and utterly trapped. But what does that even mean? What is this trap? Well, the trap is a classic economic puzzle. It's called the impossible trilemma. Basically, Japan is trying to juggle three critical, competing goals. And the hard truth is, they just can't achieve all of them at the same time. It's literally impossible. So here are the three things they're trying to do. First, they have to control inflation, which is crushing ordinary people. Second, they have to manage their gigantic mountain of government debt without going broke. And third, they have to stop their currency, the yen, from completely tanking. Here's the kicker. Any move they make to fix one of these problems makes the other two explode. And this, right here, shows you the trap in plain numbers. To actually stop inflation, the math says the Bank of Japan needs to crank interest rates up to a shocking 8.5%. But the government's budget is so fragile that if rates even get close to 3%, the whole thing breaks. They can't do what needs to be done without bankrupting the entire country. And the reason that fiscal reality is so brutal comes down to one number, 260%. That is Japan's government debt compared to its entire economy. It is by far the highest in the developed world. This single number is the anchor that's pulling every single one of their policy options down to the bottom of the ocean. Okay, so let's look at how this all spirals into something much, much more dangerous. This isn't just a static problem. It's feeding on itself, creating this vicious, self-reinforcing cycle that analysts have started calling the doom loop. And the scary part is, it's already started. So you gotta understand how this cycle works. It all kicks off when the yen falls. That immediately makes everything they import way more expensive. That, in turn, puts huge pressure on the Bank of Japan to raise interest rates to fight inflation. But the second they do that, the market freaks out about the government's ability to pay its now exploding debt bill. That fear makes investors dump the yen, which causes it to fall even further, and boom, the whole loop starts again, each time faster and more violent than the last. So you might be wondering, why is a weak yen such a huge deal for them? Well, it's because Japan is incredibly reliant on the rest of the world. Just look at these numbers. They import 84% of their energy and 63% of their food. So when the yen gets weaker, the price of everything, gas for your car, food on your table, it just skyrockets. This is a full-blown cost of living crisis. Now let's flip to the other side of the trap, the debt. Right now, about 10% of their national budget is just paying interest. If rates were to hit just 3%, which, remember, is way less than what they need to fight inflation, interest costs would eat up a massive 37% of the entire budget. And at 4%, almost half the government's money is gone before they can spend a single yen on healthcare, pensions, anything. I mean, just look at this chart. It puts it all into a crazy perspective. The blue bar? That's what Japan spends on its entire social security system right now. The red bar? That's what its interest payments alone would be if rates hit 4%. The cost of the debt would be bigger than their entire social safety net. It's just a fiscal breaking point. Okay, so far this might all sound like a problem for Japan, right? Wrong. This is the moment Japan's domestic doom loop goes global, and it all comes down to one of the biggest and riskiest financial trades on the planet. It's called the yen carry trade. For decades, investors all over the world have been borrowing trillions of Japanese yen for practically nothing because Japan's interest rates were zero. Then they take that super cheap money and go buy stuff that actually makes a return. Things like US stocks, real estate, you name it. We're talking about a $2 trillion bet that's built entirely on the idea that Japan stays stable. So when Japan's crisis starts to spiral, that entire $2 trillion trade blows up in reverse.
As Japanese rates go up and the yen gets wild, those investors get hit with margin calls. They're forced to sell everything, and I mean everything. US stocks, European bonds, whatever they bought. They dump all these assets in a panic and scrabble to buy back yen to pay off their loans. It becomes a global fire sale, and it could cause markets everywhere to just plummet all at once.
So with its currency in an absolute freefall and the whole global system shaking, what can Japan possibly do? Well, they have one last-ditch option, one big red button they can push to try and defend the yen. And that big red button is selling its most important asset, its gigantic pile of U.S. government debt. To get the dollars they need to go out and buy up their own currency, they would have no choice but to start dumping U.S. Treasury bonds on the open market. And the scale we're talking about here is it's hard to even wrap your head around. Japan is the single largest foreign owner of U.S. debt. They hold over $1.18 trillion worth. They are quite literally a pillar holding up the U.S. financial system. Now, if things get really bad, analysts estimate that Japan could be forced to fire sale as much as $400 billion of those bonds. Just to be clear, an intervention on that scale has never, ever happened before. It would be like dropping a nuclear bomb into the world's most important financial market. And the fallout from that, it would be instant, and it would be brutal. Flooding the market with that many U.S. bonds would cause their prices to crash, which would send U.S. interest rates through the roof. Suddenly, mortgages, car loans, business loans, everything in America would become incredibly expensive overnight. It would trigger a massive global credit crisis. So you put all this together, and you have this truly impossible situation. Where does it all go from here? Well, analysts have mapped out 4 potential scenarios, and they range from just bad to outright catastrophic. The most likely outcome, with a 40% chance, is what they call a stress scenario. Think really serious market volatility, some damage spreading globally, but not a total collapse. But look at the other possibilities. There's a 20% chance of a severe crisis that requires a huge IMF bailout. And then there's the really scary one, a 10% chance of a full-on systemic collapse, something like the 2008 financial crisis. Those are not comfortable odds. But here's the real kicker. The one thing you have to remember from all of this. This is not some academic exercise or a forecast for 20 years from now. That market reaction we saw, that was the starting gun. As one analyst put it so perfectly, the doom loop isn't theoretical. It's already beginning.